Should you refinance or buy a property using a 15-year or a 30-year loan? Coming up. Hi everyone, this is Dr. Ernesto, and in this channel, we give you health and wealth tips to help you be more successful. Now, a common question I get is, should I get a 30 or a 15-year loan? And there's a lot of variables, and I want to explain it as simple as possible. But bottom line, my preference is a 30-year loan, pretty much under any circumstance. So let me explain why. Let's go to this amortization schedule here. And again, you can use bankrate.com. It's a really easy to use mortgage calculator, and it'll break everything down for you. So let's say we're looking at a $200,000 loan here, 30 years, which is 360 months of payment at a 4% interest. Obviously, right now they're fluctuating. They're much cheaper right now. You can do this with different scenarios, but basically what they call the spread between a 30 and a 15-year is around 5%. Half a percent, 0.5%. So this is 4%, and my monthly payment for 30 years is going to be approximately $954.83 per month. Now that's not going to include taxes or insurance, because that varies from state to state. But the mortgage payment itself with principal and interest is going to be about the same. Now your other option is going to be over here, the 15-year. 15 years, 180 payments, 3.5%. As I mentioned, the spread is usually about 0.5%. My monthly payment is going to be $1429.77. So it's almost $500 more per month. But you're going to be done with the payment in 15 years, half as long. Another thing to consider is the amount of interest. Now, on the 15-year, obviously, you're going to be paying more. Like I said, about $500 more a year. But look at this, the total interest. You're going to be paying about $57,000 in interest at the end of the 15 years. Whereas on the 30-year, you're going to be paying about $143,000. That's more than twice as much. So people might look at that and say, wow, that's a huge difference. You know, I'd rather go with the 15-year. Well, let me show you this example I found here. And let me explain to you why you still might want to go with the 30-year. Here's a 30-year at $200,000, 4%. Payment's going to be about $955 a month. Total interest $143, as we explained before. And the 15 is right here, 3.5%, $1,430 is your payment, and the total interest is $57. But the thing I like about the 30-year is, let's say you want to become a real estate investor. If you tie yourself down with this big payment here, or let's say you have a business, or you want to take loans out to start businesses or create a startup or something like that, that large payment is going to weigh you down quite a bit. Banks are going to look at that and going to say, look, this person is already committed to paying $1,430 a month on paper, okay? So they're going to it's going to reduce your borrowing capacity for 15 years. So it's going to inhibit your ability to buy more properties, to start businesses, to create startups, to fund education, like you want to go get a doctorate in something in STEM, whatever your choice might be. It's going to weigh you down quite a bit. Now you might look at this and say, yeah, but I'm only going to pay $57,000, dude, compared to $143. I'm going to save almost $100,000. Well, this is where option number 3 comes in. This is why I like 30-year loans. See, on paper, when you try to get loans, if you have a 30-year, you're only going to be committed to $955. You're going to say, okay, this person still has about another $500 extra a month they can afford to put towards buying other properties, financing debt for businesses, etc. What you can do, remember, these properties, when you buy them, there's an amortization schedule. Here it is right here. The payment's $954, the principal's $288, interest is $666, and then the total interest accumulates every month, every time you make a payment. Okay, the balance, which is $200,000 in this case, is going to decline with every payment in principal. And as I mentioned in our previous video, when you go to the end of the amortization, there's zero owed on the $200,000, and you've paid a total of $143,000 here in interest. So your total is going to be more like $343, $739, and 1 penny you're going to pay. But look at the principal interest you're going to be paying at the end. It's $3, and the principal goes up to $951, and of course the payment is consistent. Remember, the payment is $954. It's comprised of the principal and the interest. And these loans, in this case, and always, they're front-loaded. Most of the mortgage interest you're going to pay at the end. See, at the end here, you're paying principal. This is money that's going to go to pay down your actual debt. Here's your interest, which is $3. But at the beginning, that was split backwards. Look at the interest. Instead of $3, it's $666. Look at the principal. Instead of $900 and change, it's $288, a third. So it's going to pay down your balance much lower. So now let's say you get this 30-year and you're like, dude, I don't want to pay this extra $95,000 here that I see in this calculation. Okay, well, over here in the beginning, you can immediately start making extra payments every month. And it has a snowball effect. Not just does it lower the interest for that $500 or that $1,000, it lowers the interest for that amount over 30 years or 28 years or whenever it is you make that payment in the payment schedule here. So the effect is compounded. That's why they call it the snowball effect. You know, if you've ever been to the snow, you drop a snowball, it starts rolling, it can turn into an avalanche and wipe out a whole city by the time it builds up in size. It's the same deal here. You can have a snowball effect basically of 30 years. So in this scenario back over here, this person had a 30-year loan and they decided, hey, I got some extra money, I want to pay it down. That's the other thing, it gives you flexibility. If you owe $1,430 a month, you can't go to the bank and pay $955. They're going to foreclose on you. You're going to lose your property. So it gives you options. You can buy it with a 30-year mortgage, pay $955, and then you say, hey, I don't want to pay all this mortgage interest, so I'm going to pay this much more per month, which is approximately $500 extra a month. If you look at it, it's only about $50 more than this one. And you're going to pay it off in 15 years. Okay? So you're going to get the same benefit, but you're not going to be tied down with this $1,430 hanging around your neck, not allowing you to get money to make other investments. Now, you might look at this further and you might say, hey, well, wait a minute. Sure, I'm going to save, quite a bit here, like $75,000, but this is still about, $9,000 more. I don't even want to pay that $9,000. Okay. Well, check this out. You can still do the 30-year, and remember the snowball effect. Instead of paying $1,459, you can pay approximately $1,530. An extra $50, and you'll pay the same amount of interest as this one, and you'll actually pay it in less than 15 years. You'll be done like in 13 years or something. So you'll pay the same amount of interest, but you'll pay it off faster, about 13 years, which will free you up to do other investments. But you'll only show $955 of an actual liability on your credit and counting against your income. So you're going to be allowed to do a lot of investing. So you can get all these benefits with a 30-year. It gives you a lot of flexibility. Allows you to pay it in 30 years, 20 years, 15 years, 10 years, whatever you want. And you could save all the interest, but again, you're not locked into this. I don't like the idea of being locked into these big payments. Banks look at that and they say, hey, this guy's locked in for $1,400. They don't like that. They'd rather see you locked in for $955. So it really causes a lot of problems with flexibility. In terms of interest, like I said, you can easily overcome that by just paying a little more. If you look at this, 1430 a month, you could say, yeah, but I'm going to pay 1530 here. Yeah, you're going to pay 1530 to get the same amount of interest. You're going to pay in like 13 years instead of 30 or 15. So it's actually even better than the 15-year loan. So these are some huge benefits to keep in mind. Um, I hope this helps. And if you have any questions, I'm happy to go into more details about this. Just comment below. And if you haven't already, please subscribe to our channel. Thanks again for listening. Bye bye.